Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time, and Brent crude oil is ultimately little changed this morning. Once again, $72 a barrel. And I suppose the good news from those perspective of oil producers is that it isn't falling any further. It seems to be a little bit allergic to that $70 handle. And in any time it gets close to it, it seems to somehow find a boomerang reaction to it. Will that be tested again? Let's kick off this morning with Neil Atkinson, former head of oil markets division in the International Energy Agency, and now recognized as one of the world's leading energy analysts. Neil, I suppose the big question, at least in my mind, so that's what I'll kick off with, but is we're obviously in the wave of Trump's announcements. I'm going to do this, I'm going to appoint that. Drill, baby, drill is obviously the favorite expression as to what the oil industry in the US is going to do. But my question to you is, this is a year ending unusually where we don't see any real increase at all in the US oil production capacity. What do you expect next year?
You've frozen, Sean.
I've frozen. Oh my goodness. Here I am
Okay.
blabbing away. I
We've
was
reached the end
blabbing
of the
away.
year with no increase in US production capacity. What do you expect? Something like that.
Yeah, what will happen next year? Ultimately, I suppose there's a sense of the growing narrative of Trump that everything he wants will happen. Will it in oil?
No. There you go.
Okay.
There's a very good reason for this. This drill, baby, drill thing is a slogan. And essentially, over the next 4 years or 5 years or so, while the Trump administration rolls on, the oil industry will take decisions to increase production based on the commercial realities and based on its stock of undrilled resources. And that is the key determinant. And of course, the returns to their shareholders. And the idea that suddenly Trump is going to unleash this massive wave of extra production over the next 4 years, that is just not going to happen, particularly in a world where, if you look at the fundamentals of supply and demand over the next 4 years, there is plenty of supply out there to meet the expected growth in demand. So there is really no great call for a massive expansion of US production.
Malia Bengali, founder and CEO of MB Commodity Corner. Malia, your thoughts, obviously picking up on that, but also sort of intersecting it with the financial markets. We've seen the sort of Trump bump in the last week, most significantly in Bitcoin, but also, of course, the equity markets, which were already banging their heads on a ceiling record every week, are continuing to do so while oil does not. What's your reading? Why is oil not participating in a Trump bump?
Thank you, Sean. I think Neil made a very good point. It's about supply. Now, the reason why the equity market is rallying in Bitcoin, these assets, is because Trump is very pro-economic growth and policies, right, in terms of risk assets. And then also we have a Fed chairman, Powell, right now, who actually is cutting rates when there's no evidence that he needs to cut interest rates. So you can say that the officials are sort of goosing up the economy, whereas right now financial conditions are very loose. So asset prices will be inflated. Bitcoin obviously has another micro story to it, but it's in a sense the same thing. More federal spending to come, more inflation to come into the system when the Fed is not even looking to raise rates, let alone pausing right now. But oil story is about demand and supply. Demand has remained weak and supply is ample. There's no shortage of oil. We have, even like he said, the US probably will not be able to pump that much, but then we have about 3 to 5 million barrels per day of OPEC oil just sitting there waiting to come back. Unless we see Chinese demand pick up, and we've seen Chinese demand being lowered rather than increase, OPEC's numbers are still way, way, way off. We don't see the return to higher prices. In fact, they should be falling rather than rallying. So demand supply is very important. If you look at the entire economic picture, that's actually holding up quite well.
Victor Yang, senior analyst at JLC Network Technology in China. Victor, I'm not sure if that beautiful backdrop behind you is the sun setting on China or hopefully the sun rising, but everybody's looking to China. This is continues to be a demand weakness story. Is that narrative a reflection of what's going on? China's stimulus kind of fell flat last week. Your thoughts on the outlook for China as we go into the end of the year and, of course, the Chinese New Year, which is typically a big sort of demand period for oil and energy in China?
Yes, good morning, Sean and everyone. Well, when we are talking about demand for 2024, it's surely lower than last year, particularly when we had this expectation of much higher demand earlier this year. So you can see that this is kind of contrast between the expectation and the actual demand. Up to now, the country's demand has dropped, yes, well, that's for sure. And for next year, we expect a modest rebound because of some new projects and state-owned refineries upgrade projects that help to boost chemical production while lowering oil product production, such as PetroChina's Jilin Petrochemical upgrade project in Northeast China. One of these refineries upgrade projects can help to reduce oil product output, gasoline and diesel, by over 2 million metric tons per year. So this can be a stimulus to the country's oil demand. And now we are still waiting to find out the result of the country's latest stimulus, or we could say not actually stimulus, but it's moved to resolve local government debt. And that can help to give a boost to the country's economy too. Particularly now, the country is trying to achieve its annual growth target of 5%. It's a great challenge. Yeah. So we still, but this will not be immediately seen, immediate effect. It will take at least 12 months for significant outcome to be seen. Yeah.
Victor, just to follow up, we saw yesterday the OPEC monthly report, and while they revised down once again the demand growth forecast for China for 2024, they still have it as about 400,000 barrels a day. Is that concurring with your data, China growth, demand growth this year at 400 or so barrels a day? Or what is your data saying about Chinese demand growth this year?
Well, if you say it's a decline of 400 barrels, not that much.
No, not a decline. OPEC is saying they see this year an increase.
Yes, I know what you mean. Yes, well, I mean, if you say it's a decline, it would be closer to the truth.
Okay. All right.
But it's not a big decline. Not a big decline, but it's actually a decline. Yes.
It's actually a decline in growth. So Neil, just picking up on that, I mean, we're ending the year, we still have OPEC at about, I think they were at 1.8 in the report yesterday, demand growth this year, still about 1 million barrels a day separating them and the IEA and the EIA in the United States. I've heard sort of commentary this year and certainly in the last few weeks saying that this gap, this sort of really significant divergence in the forecasting and the outcome has been quite disruptive to the markets this year, creating expectations where they weren't and so forth. I'm just wondering your thoughts just on the dynamics around this sort of institutionalized forecasting, which of course has been the bedrock of the industry for so many years that you participated in. As we end the year with the first time of such great divergence, I'm just welcome your reflections on the impact of that scale of difference.
Well, when I led the IEA's oil market division, of course, our forecasts were always on point and brilliant and perceptive. And that's
goes without saying.
Continued since I left. And I have to say, I think my colleagues at the IEA are far closer to the reality than is the case with OPEC. And indeed, even at the beginning of this year, when we were all gathering in various places in London, happen in 2024, the consensus amongst most independent analysts and consulting firms and investment banks was that global oil demand would go up this year by no more than about 1.5 million barrels a day. We were saying that back in January and February. At the same time, OPEC was saying that demand would go up by 2.2 or 2.3 million barrels a day year on year. The IEA was lower at about 1.3, something like that. And there's always been a feeling that perhaps the OPEC Secretariat numbers are not as independent as those produced by IEA or the EIA. An element of OPEC talking its book. It has an institutional view that oil demand is going to continue to grow strongly for many years to come. On the other side of the fence, the IEA thinks we're heading towards peak demand by the end of this decade. So in a way, lower demand growth would fit in with that narrative. However, the reality is whatever view you take about the strength of demand, real data that has come in as the year has progressed has clearly shown that after a bumper year in 2023, led by China's recovery from the COVID pandemic, normality has set in, and we are seeing demand growth much closer to 1 million barrels a day, and the IEA deserves plaudits for that. But OPEC, you know, it seems to be slowly getting there inch by inch. It's cut its demand growth outlook 4 months in a row now, and it's getting, it's still 1.8 million barrels a day. And I
mean, just to be somewhat agnostic, Neil, to the, obviously the divergence is substantial and remains so, and the reasons behind that one only knows. But I'm more sort of focused on, regardless of the correction, right or wrong, who's closer to the bullseye or not. But the fact that we just have such divergence in forecasting and the research that leads into that forecasting. Its impact on the markets. Do you think it had anything to do with the sort of that first half of the year perception that maybe it was going to be a much better demand growth year than it turned out to be? Because everybody was above where it seems to be, right?
Yeah, sure. As I said, every independent analysts, including me, thought about 1.5 million barrels a day, and we should hold our hands up and say that that has not materialized. But I'm not sure investors are sort of having great agonies every month when the OPEC and the IEA forecasts come out. They pay attention to them, of course, because they should, because the IEA in particular has greater access to data, particularly from non-OECD governments, than perhaps anybody else does, and they are more likely to be closer to the truth. But I don't think it's causing too much angst amongst investors, because of course they have their own views. I mean, you've only got to see,
of course.
ExxonMobil published an outlook back in August, which is very, very thorough indeed, and is actually relatively bullish. So
Maliha, just pick up on that, because I think it was like, for example, coming out of the summer, it was quite of a shock moment when prices in Brent dropped below 70. Because the market was kind of surprised by the China as Victor just said, declining this year. Nobody picked up on that. I'm wondering, and I wanted to get your thoughts anyway on the financial actors here. Would they be incentivized to come into the market now, prices dropping through 70? Would this kind of inconsistent data scare them away? Your thoughts?
No, I don't think.
I just want to get Maliha on that, Neil. Sorry.
Apologies,
Thank you, Sean. Yes. So during the summer, the data, the US economy is the only one that actually is holding up from an economic perspective. But in the summer, even the US data was rolling over. We saw PMI, ISM, everything is looking quite shaky. Now, we've spoken about the rest of the world versus the US economy. Every single part of the world, the Eurozone, China, it's all been deteriorating, and US has been holding up, which is why US has worked really well. Now, in the summer, even the US data was showing weaker demand, and that's why the Fed panicked and cut interest rates. So let's take a step back. The oil markets, the physical side, our flows have always showed weakness. Chinese demand, there have been secular shifts. Distillate demand has been weak. Product demand has been weak. These are all the factors. Refining margins have been really low. So this all leads to lower oil demand. And I think that's one thing that's really important. We know that these academic institutions, IEA and all, are very sort of academic. They sort of have these long-term projections, but they don't get the cyclical factors right. We track on a macro basis, and our 3-month forward basis has been showing weak demand all throughout the year. So oil prices cannot rally. And then you have the supply side. Yes, this is of a very live factor. And Chinese stimulus this year, we've seen they've come and announced 10 trillion of debt sales and bond issuance. It's not enough. The Chinese government needs to do a lot more. There's a lot more talk than actual action. And this is why we've seen commodity demand. Copper has failed to rally as well. And copper is still tighter than oil. So look at the whole commodity spectrum and the economic data. But yes, in the summer, things were getting really, really shaky for the US because that is the only part of the world that's holding up from a robust economic growth compared to Eurozone and other sectors. And I think that's what the financial markets are pricing in. And now we're seeing a bit of a pickup.
Victor, well, you asked sort of my opening question to Neil about how the U.S. oil industry would react to Donald Trump's wish list of, drill, baby, drill, in the sense of, produce a lot more oil. How will China react to the tariffs that are apparently now coming your way? How do you think that's going to play out?
Well, I think China has been preparing for additional tariffs too, not just lately. And so it now has been focusing on domestic consumption more than before. So it has stressed this year more than before that domestic consumption will be the main driver for growth instead of export. So more attention is shifting to domestic consumption. And another way a measure is expanding, trade with some other countries, such as action. And
we saw recently a signing with India, even in Russia during the BRICS meeting, the Indian and the Chinese leaders signing an MOU to increase trade.
Yes, and it's trying to expand trade with some other countries as well. And when we are looking at the trade for this year, for the first 10 months, China's trade with countries in Southeast Asia, with EU, with the United States actually grow. The growth with the countries in Southeast Asia is the largest, and then the EU and the United States. So actually the trade with the United States was still growing despite the tariff. Yeah.
Will Victor, do you think the policies of Donald Trump's new government make it more difficult for China to grow next year?
Yes, it would be more difficult to grow, or at least at this rate, as in the first 10 months of 2024. But this trend will not be reversed very, very soon, because they still depend a lot on Chinese products. They are not so dependent, yes, on a lot of products.
Okay, let's go to the survey question, which touches on some of these issues that we have been discussing this morning. U.S. oil production capacity didn't grow this year. What do you expect in 2025? 1, little change, 2, some growth, or 3, rise a lot? What do you think will happen in 2025? Neil, I wanted to get your thoughts on Europe, because ultimately it could be in Europe where things change quickly, or potentially that's what there seems to be the indications in terms of the geopolitical and the conflict in Ukraine, Russia's invasion in Ukraine and acquisition of a big chunk of its territory. That playing out, if you look at the Trump the Trump narrative is quick deal. Russia more or less gets what they've gained. They lock it in. How is that likely to play out? Will it change the energy flows in Europe, rehabilitate the energy flows as they were? Your thoughts on the geopolitics playing out and then its impact towards the energy flows for Europe?
Well, I would think if I were a Ukrainian, that somebody coming along and saying, "Leave it to me, I'll fix this in a day," I would think feels pretty insulting. I don't know what the casualty figures are in the Ukraine, but many, many people have died. There's been massive destruction of infrastructure, towns and cities in the country. So for someone to come along and say, to all purposes, stop this now, otherwise we're not going to continue to support you, and here, Russia, you can have what you've already gained. But if that's the political reality, then so be it. If that does come to pass, and there is, to all intents and purposes, an end, however temporary that might be, and I mean temporary not in the terms of weeks, but over a period of years, because Putin isn't going away. If there is hostilities, I would not be surprised if Russian pipeline gas were to start flowing back to Europe over the next months, years, whatever, after any kind of deal is signed, simply because there is so much of it. And Europe would want to ensure that it is not wholly reliant, or as reliant as it's turning out likely to be, on, for example, US LNG. And I'm not saying there's a risk with US LNG. There isn't. The US will sell as much to Europe as Europe is willing to pay for. But I think there would be a strong possibility that inevitably Russian gas would be made available again. And in terms of commercial reality, based on some sort of political agreement, then Russian supplies would flow.
Malia, your thoughts on that from a point of view of where that would flow into the markets? I mean, it as you have indicated, the price in the commodity space and in energy should be possibly falling already under current circumstances. How do you see these geopolitical theaters playing out and impacting the flows that where more or less supply is a reality of 2025?
These are good questions. I mean, obviously, there's a rhetoric that Trump is going to be harsher, or seen to be harsher to Iran, and that could obviously pull some Iranian oil. But at the end of the day, that could just change flows and see more Saudi or OPEC oil coming in the market, right? So it's going to be replacing one or the other. And then you have China on the other hand, they're still going to be buying Iranian oil. So it's not as easy and a clean cut out. But like we said, there is no shortage of oil. And if anything, Saudi market share has been falling, so they want to release more, not less oil. They've been delaying the inevitable by one more month, because the demand numbers are completely offside. And they were hoping for this lovely voluntary cut to work for 6 months' time. It's been 2 years. We haven't seen that oil come back. So, like I said, all this oil is sitting right there. So how can we see a recovery in the market unless we get all that up? And that'll only be a global synchronization recovery like we saw back in 2008 or 2009. We don't see China doing anything of that sort, or the world on that matter. And I think that's a key issue for oil. Some other parts of the commodity market may do better. But like I said, the demand supply balances do not favor oil, even with that shift in geopolitical sentiment.
Victor, we've seen in China that over the period of, or maybe always, but certainly since COVID, that despite whatever the macro backdrop in China, when oil prices have fallen to a nice attractive level, the Chinese have bought, right? I mean, obviously they've bought discounted Russian and Iranian barrels, but in terms of the international markets, $70 on Brent is typically a number in which Chinese buyers like to put some away into stocks. Your thoughts on these price levels and the potential that Chinese buyers will jump in and grab some tankers?
Well, in the past, when crude price dropped to $60 to $70, well, they would become quite attractive to Chinese buyers. For this year, things were a little different because the domestic oil product prices have been relatively weak compared with cost. So this had dampened buyers' interest to some degree. But in the coming months, there can be a modest rebound in their purchase, since crude prices dropped quite significantly. And some independent refineries that had run short of quotas had just applied for additional quotas for 2024. So they can, boost their purchase in the last 2 months of the year. Yeah.
Victor, just to pick up on the point there by Maliha, and of course it's generally thought to be the case that the Iranian exports the Chinese imports of Iranian oil are insulated from US sanctions. But I've been hearing here in the Gulf from bankers and traders that the Chinese are growing sensitive around particularly Chinese banks to facilitate both Russian and Iranian sanctioned oil. Your thoughts on how sensitive a more, of course, aggressive U.S. administration, the Biden administration, has been a little bit soft, or whatever the language is, hasn't really been a big enforcer of these sanctions. Are the Chinese industry, the Chinese banks, likely to be more sensitive to the Trump aggressive policy? Your thoughts on that, China's willingness to continue to import what the U.S. regards as sanctioned oil from Iran and Russia?
Yes, well, usually at the beginning of strengthening sanctions, well, Chinese banks would be more sensitive. Yes, that's usually the case. But over the time, gradually they would handle it. And that was the case last year too, and this year too. Well, so the most important thing is, well, the prices of sanction cargoes are attractive enough to Chinese buyers. If they are attractive enough, they would, well, move away these obstacles and continue to purchase these cargoes. And that's for sure.
Neil, wrapping up with you, of course, the next sort of big sort of North Star, as I call it, on the oil markets, or certainly one big one, is the OPEC Plus meeting in a few weeks' time in Vienna to make plans for 2025. They have postponed their sort of commitment to increase supply. They pushed that now to January 1st. Your thoughts on the kind of decision OPEC Plus is facing here? Increase, unravel the cuts or not, and what do you think they may choose to do?
Well, I don't think there is any headroom for them to increase supply to the market. I think Malia's made this point pretty forcefully.
I mean, it's certainly from a demand point of view that seems quite obvious, but from another perspective, politics, market share, continuing to allow the US to consume their lunch. I mean, there's other reasons that one might think about here.
Yeah, sure. But I mean, we've been having this argument for decades now about market share versus price. And the reality is that if they do put more oil into the market, demand growth remains lower than we might have thought a while back. And on the other side of the fence, the non-OPEC producers increase their output to the extent that we're expecting. This isn't just a bit of an increase in the US, but you've got Brazil, you have Guyana, you have Canada, you have other bits and pieces from elsewhere. You know, you can't have more production coming into the market from OPEC Plus and have prices staying above $70 a barrel. You know, you need to make a choice. And I'm afraid that the OPEC Plus countries are just going to have to suck up this current market reality, which is going to continue through 2025.
Well, suck it up. We will have to finish here today with some growth in U.S. oil production forecast from this room, and we'll certainly play that out on the social channels and see if there's concurrence on that view. Brent crude oil at $92 a barrel. I think my own view on the OPEC Plus, the meeting is I think they're going to consider a lot of things because regardless of what's happened, the UAE has a quota increase that starts on January 1st, and they will not be giving that up. Whether everyone else will stand on the sidelines as the UAE increases, I think that's a big question of challenge, because when that was agreed back earlier in 2024, it was agreed in the context that everybody was going to be able to be increasing, not just the UAE. So that's going to be a tricky one for that meeting, and so I think a lot to consider ultimately. We have a good halftime talk this week on the reaction Trump's second term. That sort of first question I asked Neil, how will the reaction to Trump be on all of these issues? I think that's a big question on all fronts. China on tariffs, US drill baby drill. Will the ExxonMobil listen to that, or simply say, well, thanks Thanks, but no thanks. Neil Atkinson, as always, thank you so much. Your great insights. I really appreciate it. Mahalia Bengali, the same. Victor Yang, all around the world in half an hour, from the UK to Paris to China and Dubai in the middle. Thank you so much. Have a great week, everybody, and catch up with you soon again. Bye-bye.
Thank you. Bye.